Welcome to the Startup Grind.
So usually we like to start these by hearing a bit about your background so that we have an idea as to how you got into the world of entrepreneurship. So
Sure.
Tell us a bit about where you're from, what your parents did, and your childhood.
So born and raised in the Philippines. I grew up in Manila. Came over here when I was 17 years old. I took my senior year of high school here. Primarily because my dad, who was working for a private equity firm or investment firm in Manila, his firm ended up buying a furniture company in Miami, and he was the most junior partner, so he was the one shipped off to run it. So the entire family went. It was tough. It was my senior year of high school. I went to an all-boys Jesuit school. 400 people in my class ended up going to a very conservative Southern Baptist school with 56 kids in my graduating class, and the only Filipino guy in class. So, but it was an interesting transition. So, my parents were both finance professionals. My dad, I guess he's a lifetime CFO, controller type. He's still in his retirement job, so to speak. He's the CFO of a nonprofit in Miami. So we've all stayed in the U.S. after. This was in 1986 when we moved. My mom is a retired person now, but she was also a finance professional throughout her career, both working parents.
And so, did you have any specific interests or anything that sparked your interest as a kid? Did you play sports? Were you big on computers?
Yes, I played a lot of sports. In spite of my very petite 5'7" frame, I did play a lot of basketball, believe it or not. Thankfully, both my kids, and I have a kid who's actually been a varsity player since his freshman year, is 6'1". And yes, he is my kid.
You got mom's genes though? You get mom's genes?
It's all from the mom. It's all from the mom. And my 14-year-old is also going towards that height. So I did play a lot of sports. I've always been interested in business as a small kid, as a young kid. Didn't really know what I wanted to do until after undergrad, so I can't really recall what I wanted to do, but I was always fascinated in the commercial sense of business in general.
And you went to FIU, Florida International University?
Yes, so I went to, after undergrad, I stuck around in Miami, went to a local university called Florida International, and stayed there until I graduated in 1990. So I was a December graduate. I had some units I had to catch up on. And then shortly after that, moved to Los Angeles, and that's when I found my first job with Arthur Andersen. I was, I guess, the equivalent of a junior associate at that time. It was about, my first real job was, my one and only corporate job, in fact, was started in March of '91. And I was with Arthur Andersen for about 4.5 years. My plan was to stay in for 5. I failed a little bit, only lasted 4.5 years. And I was in the retail management consulting division, not on the audit side. So I was on the consulting side of things.
Awesome. So 1990, you're in sort of finishing school, right?
I finished in 1990.
So obviously, had you finished 10 years later, there would probably be this huge influx of people saying, go into tech, move to the Valley. Being that you were a bit earlier, and you came out to LA, what was happening out here in the early 90s? Was there one industry that was hot, or any companies that you really potentially maybe wanted to work at? What was on your horizon?
Back in circa 1991, not much was going on in tech in LA, and I wasn't really thinking much about tech back then. My life plan, so to speak, let me backtrack a little bit. So I still remember vividly, right after taking my very last class in undergrad and walking back to the parking lot and to drive away from school, thinking to myself, what now? Because I had no idea what I wanted to do. I studied journalism in college. I don't mind writing, I actually enjoy writing. But the reason I did journalism was because I thought it was going to be the easiest path in college, and I wanted to have a really good time and really enjoy life in college. Wasn't much of a techie. I did a fair amount of business courses and dabbled a little bit in some technical courses to kind of just learn enough in that space. But really, it was a very broad degree in journalism, and so finished in '90, moved here. Not much going on in tech. we serviced a lot of retail clients in the Midwest.
And can you tell us a little bit about what Arthur Andersen was and what your role was?
Yes, so I was in the retail consulting side, as I said. We worked quite a bit with large big box retailers. Let's see, Kmart, if you guys recall Kmart. My division was I believe it was the founding team of the Super Kmart concept way back in the early 90s. Dayton, Hudson, Farmore. So a lot of these large retailers in the Midwest. So did quite a bit of back and forth there. So back to your question about tech. To be honest, I don't recall what was happening in LA back then, but I'm pretty sure not much was happening because I thought I stayed pretty in tune. And but LA was a diverse economy, and it still is. So there's a lot of things going on, but not much on the tech side, which what I've been doing for the last 15, 17 years as both an operator and as an investor.
So you were at Arthur Andersen for about 4 years.
4.5 to be exact.
4.5, and then what was the role after that?
So I promised myself that I was going to leave. So during Arthur Andersen, I went back to business school, did Pepperdine's fully employed program, just because, to be perfectly honest, my parents expected me to go to grad school, so I had to check that off. And
were they happy?
They were very happy.
That's
they were very happy, and because they were both finance professionals, they were very happy that I was with a very prestigious Big Six firm at that time, who's no longer around, as you know. Got killed by Enron. So 5 years was the plan. Lasted 4.5. Left in summer of 1995, August of 1995. Probably one of the happier days of my life. So I raided my 401k and a little bit of savings outside of that. I had enough personal runway for about 18 months, and basically just figured out that I will figure something out in the next 18 months, and if I can't, then I'm not a deserving entrepreneur. I can always go back to work. Reported it back to my parents saying, okay, I'm now leaving, so that was a very awkward conversation. They were very supportive, but clearly very nervous and kind of puzzled why I would leave such a cushy job, especially after finishing business school, where the chances of mobility within the corporation would have been a lot higher. So left in August of 1995, and basically was confident enough that I'll be able to figure out something. But I got lucky. This was 1995, and for you guys, it looks like a lot of young people in the room, but 1995 was really when the internet was being commercialized. A lot of the iconic names that we all know about were started in that region, in that area, from 93 to 97. The Yahoos, Netscapes, eBays of the world. AOL was a veteran back then. So all these things were happening. And I guess the primary driver of me leaving big corporate was I wanted to kind of just claim my own piece of the pie without knowing what that would be. And so that was the start of, I guess I consider myself having been self-employed or free agent since, I guess, 21 years now, which is, I thought was pretty neat when we celebrated 20 years.
Is. So August of 95, you decide that you're gonna figure it out. You have about 18 months of runway.
Yep.
And what happens next? What sparks the fire?
So Amazon was formed around 94. Read a lot about this guy named Jeff Bezos. He was definitely, I don't know him personally, but definitely very inspirational. Had no idea where Amazon was going. Not being the techie that some of my friends were, I wanted to get involved in the tech scene, but looking for the sort of the lowest hanging fruit, so to speak. Not a lot of tech barriers to entry. So I ended up thinking of maybe I can pursue an e-commerce play. And in my days in Arthur Andersen, I got exposed to a lot of specialty foods concepts. And so decided I will pursue an InnerFoods, a specialty foods play, and eventually called it InnerFoods.com. And this was probably formed around September of 96.
Was it
So
just you when the concept got off the ground?
Yes, it was a single founder and had no idea what I was doing.
You didn't know what you were in for.
No, I had no clue, and ignorance is bliss sometimes.
So you started by yourself,
Yep.
and the concept was what?
So the concept was to sell specialty foods online, and the way I define specialty foods were really, really hard to find delicacies, mostly European delicacies online. And I did what most entrepreneurs did, was basically created a website, made it look like it was fully stocked, and had digitized every single SKU out there of stuff that I wanted to sell, without necessarily having the inventory behind it. And I figured if somebody was dumb enough to buy it, I can run to a specialty food store and buy it and kind of just test it that way. So that's the way InnerFoods got started. 6 months into it, I realized that a lot of these specialty foods providers will not sell to an unknown startup, much less a guy that has no experience in specialty foods. So that was a big problem. Supply chain was an issue. I couldn't sell anything I didn't have. I couldn't sell negative margins. So that was 6 months into it. I realized, oh shit, how am I gonna do this? And I got lucky. A friend of mine, by the name of Chris Cheng, I'm no longer in touch with him, but I still remember him. I'm very grateful for the introduction. Knew about a company in Bellflower here locally, a company called Holland American, which was at that time a 35-year-old importer of Dutch foods. He was a Dutch immigrant by the name of Mr. Van Willigen was the one who started it, and he was retiring, and he wanted to sell the business. He was doing probably about $2.5–3 million, but I didn't really care for the volume of the business. I really cared about the Rolodex of suppliers he had. And so I met him, and I couldn't believe it. I guess we hit it off. I may have reminded him much young version of him back then, and he decided to sell his business to me for inventory value. He had inventory worth $500,000 at that point, I think at that time, and he decided if you can raise $500,000, I'll sell you the business. And that's how I solved my supply chain. I of course did not have $500,000 and didn't know how to raise money. And the second sequence of luck happened. I went to an aunt who actually had some resources and basically said, here's what I'm looking to do. I'm looking to buy this business to solve my supply chain issue. And I need $600,000. I just figured I'd bat it a little bit for working capital. She had no idea what I was talking about. She had no idea what equity is, what debt is. All she said was, look, I have no clue what you're telling me. All I know is you're asking me for money. Let me do this. She's very religious, by the way. So come back in 2 weeks, let me pray about this, and I'll let you know my answer in 2 weeks. It's a true story. So I came back in 2 weeks, and she said, I'll lend you the money for $600,000. I don't want to buy a piece of your company. And I guess she researched the last two weeks prior.
She didn't just pray. Right? She didn't just pray. Okay.
She didn't want to buy a piece of the business, and she basically loaned me the money and said, if you lose this money, you'll still owe it to me. I don't care how you pay it, but you'll owe it to me, and you better not make me make a call to your dad. But go buy the business. So as a result, I was able to keep a larger chunk of the equity because I didn't have to sell the equity of the company. So long story short, went ahead and purchased this business called Holland American, and that effectively solved the supply chain, and from there it tracked quite nicely.
What was user acquisition like?
Oh, just a lot of banner ads in Yahoo back then.
Oh, okay.
Yeah. I couldn't tell you what the cost was. I completely forgot. But back then, there was no such thing as really, user acquisition. Everything was being experimented online. So we bought a shitload of Yahoo banner ads and AOL banner ads, and kind of just threw stuff in the wall, see what stuck.
And so, how did you scale up the business internally? Were you hiring? I'm sure you're learning about how do I fix my supply chain issue? How do I raise capital? And at some point, you got to hire some people too. So
yeah, so we ended up inheriting. I ended up inheriting about 12 people, I think, in the business that we kept. So that was the fulfillment center. So we moved the business to Bellflower. It had a facility, so we ended up renting from him. The real estate wasn't part of the transaction, so we were renting from Mr. Van Willigen, and hired enough people. I think at the end of the day, we ended up 35 to 38 employees. And the wholesale business remained steady at about $2.5–3 million, and the online business grew to about $3 million. And so fast forward to sort of late '99, a large retailer here. Actually, along the way, we made one strategic acquisition of another specialty foods, and in the middle of 1999, there was one of the larger specialty food manufacturers here locally ended up acquiring the business.
And was it an acqui-hire, or did they just? No.
It was a real acquisition, and they wanted to figure out the e-commerce portion of the business. They wanted to see if they wanted to test it. They paid a real number for it, but their ulterior motive was to figure out if they can really sell a lot. They were more on the wholesale and manufacturing side of things, and they wanted to figure out the e-commerce space. So it was just serendipitous that we met, and they ended up doing the acquisition in July of 1999 or something like that.
So it was roughly 4 years that you had the company?
Roughly 4 years, yeah.
Okay. So during those 4 years, I'm sure there were lots of ups and lots of downs. What was the most exhilarating part of it for you?
The most exhilarating part is
gratifying.
When the most gratifying part was when outside of the acquisition, which was a very gratifying part, was when we finally figured out how to solve the supply chain aspect of it, because you could really see the numbers move. One, you had products to sell, and there was quite a bit of learnings from that acquisition, from how to keep sustainable gross margins. Overnight, I found out what the margins of the suppliers were, and was able to apply that in the online side of the business.
In regards to your own personal strengths and weaknesses, was there anything that really stood out to you after getting deeper into the weeds with the business that maybe you should delegate to other people, or that you should just solely do yourself?
Absolutely. I suck in administrative stuff, so it's not something I enjoy. Even today, my wife takes care of all the bills and all that stuff. So so very important to really surround yourself with some good professionals to take care of all the mundane stuff that you don't enjoy doing. I very much enjoy the strategy aspect of it, sort of the big picture approach. I very much enjoy speaking with strategic partners, and I don't mind operating, and I certainly enjoy interacting with personnel. But at some point, looking back at it now, one of the reasons that I decided to sell the business was it was getting a little bigger, and for us to get to the next scale, which in my definition of the next stage was about 25 million in revenues, it needed more capital, it needed a bigger organization, and I wasn't sure I had the core competency to do that. And there was an opportunity to and keep in mind that was mid '99 when things were really rocking and rolling. So there was a fair amount of enthusiasm on the buyer side as well. So I just took advantage of the opportunity to basically give that to a buyer that I thought would be able to have the resources to take it to the next level.
And when you talked about why you started the company, and in regards to barriers to entry, nowadays, obviously, I think that in some industries, there's less barrier to entry because of technology, but obviously the food space is a bit different than any other vertical or any other industry. What were some big learnings from working in the food industry? Were there things that shocked you, or maybe any advice that you would give to entrepreneurs thinking about starting a food business today?
What shocked me back then was the fact that they won't give me credit. I guess I felt entitled that I needed to get credit from these suppliers right away. So that was a pretty shocking learning that at a certain scale, nobody really cares about you. So you have to figure out how to, one, solve your supply chain issues. Number two, solve your credit issues. the biggest learning there is really, I did not succumb to selling $1 for 80 cents, for example, because I never had the resources to do that. That was what Amazon was doing for about 10 years, and they could afford it because they had plenty of resources and a lot of. There was a company called GreatFoods.com, which was really where I modeled the company up in Seattle. That was eventually acquired by Teleflora for about 35 million or 40 million bucks, and just observing them, I thought that they were selling at a negative margin to be able to get market share. So that was pretty shocking to me because I've never, even in my career today, I've always, when I look at something, I try to understand what the business is. I try not to get excited about the concept or the prospects or the size of the market. I try to understand what the business underneath this whole technology is. So back then, really the biggest learning was the fact that you really have to have positive and sustainable gross margins from day one to be able to have a sustainable business. I was more interested in having a sustainable business rather than growing fast. I didn't know how to raise money back then, so I didn't really have any backing. And even if I did, I probably would have stuck to my guns of having a sustainable gross margin business, because at the end of the day, it's all about your unit economics. Everything else is noise.
Did you feel like during your first experience as a founder that you got a lot of advice or a lot of people looking to give you advice? And if so, how do you filter through that to really identify, what's bullshit and what you should maybe hone in on?
It's hard to figure out what bullshit is if you have no idea what you were doing. So there was a lot of noise. People were giving advice left and right. To be perfectly honest with you, I think I listened to a lot of advice. I listened to everybody that was willing to dispense some advice, but I pretty much stuck to my guns and trusted my gut in terms of what needed to get done. Made a ton of mistakes. That first exit was more lucky than good. But at the end of the day, I guess my advice to everybody here, and I keep telling this to my kids, was, look, if you have enough confidence in yourself, just stick to your guns. And you can always make mistakes and you can always go back. Because I wasn't really aware of any experts in my field that were really, again, this was 99, e-commerce was trying to get figured out. There was no category leader back then. So I just stuck to my guns and basically filtered out the noise, which is a personal philosophy that I still have to today.
So it's July of '99. The company's just been acquired. Now what?
During my startup phase, I had a 9-month-old, I believe, when the first exit happened. No, I didn't take time off. When I knew that eventually the company was going to get sold, I started plotting my next move. I wanted to continue the momentum. It's a nice little high to have. It's almost a game changer because having to sustain yourself in 18 months worth of runway, making sure that you have enough personal runway to all of a sudden having some resources to be able to have some options is a nice feeling. But I wanted to sustain the momentum, and a friend of mine and I started plotting the next step, and which led to the next startup that I did.
And the next startup was called SightStar,
yes.
Correct?
So SightStar was, to be perfectly honest with everyone, it was more of a financial pursuit because there was nothing innovative about it. SightStar was plainly an ISP. Basically, we provided connectivity, narrowband connectivity to homes. The twist there was we were looking for an underserved market in the US. We thought it was going to be Central California, but there was a very well-financed company that went in there by the name of John Ledecky with, I believe, One Main was what it was called. So we were looking for an underserved market in the US that the national providers did not really care much about because there's no density, there's not much scale. But people lived there, and this was '99 when email was just really becoming predominant in the masses. We had, even back in Arthur Anderson, our email was really intramail. We really couldn't email outside. It was
like the first version of Slack, right?
Right. It was Lotus Notes. For you guys old enough to remember. So that was what happened. So we found a company in Annapolis, Maryland, called SightStar that had 600 subs. So we spoke to the founders and basically said, this is what we're planning on doing. We wanted to, instead of starting from ground up, we wanted to have a very small base of customers just to have enough learnings. So we ended up buying that business and moved it to what the little triangle that we define as our mid-Atlantic triangle between Mount Airy, North Carolina, Martinsville, Virginia, and Lynchburg, Virginia. Nearest major airport is Raleigh, North Carolina. But we were two California boys based in LA doing business in the Mid-Atlantic region. So that's how, that was the genesis of SightStar. So the plan was, our thesis was, if we can grow this thing to 50,000 subs, we were pretty damn sure that we would be able to attract a national provider to acquire it. Again, it was mostly a pure financial pursuit, and so we did. So we got going shortly after InnerFoods, probably about third quarter of '99, and
so you didn't waste any time then.
No, I didn't. Literally did not take time off. It just basically.
And I'm sure that you probably for 6 months at least already knew that this would be the next thing potentially.
There were some ideas and some theses that we were playing around. It finally formed shortly before I decided to sell the company. Yes. So the difference is we had raised some money. Again, going back, putting some context. This was 1999, so I was prepared to raise conventional venture money because it needed money to be able to really grow it from 0 or 600 to 50,000 subs. But this was 99 when everybody was really so excited. So instead of raising traditional venture money, we ended up raising from a hedge fund. So we ended up raising, I think, about just a tad shy of about $2 million. We raised a little bit of money to get started and raised about $1.5 million to get it going. And so we ended up just simplify the math, call it $2 million. So that's all we raised, and then basically grew the business from there.
And so you never raised another round?
No. It was the ISP business. A little dirty secret there is it's really profitable from day one if you run it like a real business. It's a 35% EBITDA margin business. As unbelievable as that sounds for an narrowband business, but it was very profitable from day one. It was just a question of just scaling the profitability.
And was the assumption about being in Virginia the right play?
It worked out for us. Yes, it was the right place for us. It had enough density. Lynchburg is a bit of a college town, so it goes in cycles. Most of our customers were just interested in checking their email. They didn't really spend a lot of time browsing back then. We did just like any other ISP did. We basically tracked 10 to 20 accounts per account and basically figured out the usage during the daytime, during the nighttime, and then expanded the first version of AWS where you can expand it based on the usage. But because email was the primarily use, it was quite flexible. But back then, equipment was much more expensive. A pizza box server back then cost $20,000, which the same pizza box server today probably costs $800.
So at the time for SightStar, how did you meet your co-founder, and what was his role, and how did your skills complement one another?
Yeah, so my co-founder, I met him through a mutual friend. He's a real hard-ass operator. I give him a lot of credit for the success of SightStar because he was the one that really did a lot of the heavy lifting in terms of going back and forth. I didn't travel as much. He traveled most of the time. And so we had complementary skills. He really enjoyed the day-to-day company building aspect of it. And at that time, I sort of relegated myself to a little bit more strategy, more vision type. So to this day, I mean, he's moved on. He's parlayed his winnings, so to speak, and built other businesses. But he was really complementary to what I thought and what the thesis I was pursuing back then.
And so, how long were you involved in the day-to-day at SightStar?
I was involved from the start to from the beginning to the end, not as much as he was though. So I'd say that if he was spending 100% of his time operationally, I was probably spending about maybe 50-60% of my time operationally. But from a high level, on the board level and all that, I was very much involved.
And then, so what ended up happening with the company?
So we ended up selling it to so our thesis stuck. We thought that if we built it to 55,000 subs, somebody would buy it. So we did receive we received a term sheet from one of the national providers out of Atlanta, without mentioning his name. They looked at it as merely pop accounts, and they were going to lay off the 34 employees that we had. So we chose to sell it to a local competitor in Lynchburg, Virginia, and that continued the strategy. So we sold it. We were doing about $1.5 million of EBITDA by the time we sold it, on revenues of about $5 million, and the buyer ended up doubling the business in the next 2 years. The reason we sold it was because we thought we were hearing the broadband footsteps. The broadband was already proliferating in major cities, and we thought it was just a matter of time before it gets to rural areas. We were probably 2 to 3 years a little wrong on that. We probably could have held on to it. But it was a good outcome nonetheless, so no regrets there. But we ended up selling it the worst time you could actually sell a business, which was December of 2002. But because we were profitable, we had some leverage and we didn't have to sell. But we didn't have to sell, but we felt we had to sell because of those sort of imaginary footsteps that I mentioned.
So you get done with your second business, and you had raised money from a hedge fund.
Yes.
So at this point, you've had enough of being a founder for a while, at least?
Yeah, so I was feeling pretty good about it. 2 for 2, 2 nice outcomes. We didn't raise a lot of money, so we captured a lot of the equity as well. So I took some time off. I think it was a 3 to 4 month time off. I had a 4-year-old and a 1-year-old at that time, and I thought there was going to be a third idea. I had no idea what it was, it ended up to be nothing. I had no operating idea anymore, and so I ended up basically migrating to the dark side, as any entrepreneur who's run out of ideas have done.
So you decided to join a hedge fund.
Actually, before the hedge fund, I started a small, what I just was loosely calling back then, a small angel fund. There was a company called, I called it Frontera back then. This was in about February or March of 2003. But we really started investing actively probably later that year. So it was practically myself and 6 other guys, 6 other entrepreneurs that I knew that have done well in previous lives, that enjoy angel investing but didn't want to do it on a full-time basis. And so that ended up to be an $8.2 million fund. At first it started as a pledge fund and then eventually migrated to more of a committed fund. And
you didn't have LPs? It was
it was just 6 of us, actually 7 of us. So myself used a lot of my personal capital, and then 6 other guys did. So we ended up investing in 42 companies. The whole thesis back then. So I consider that my third startup, was the sort of the investing aspect of it. The whole thesis was let's invest in companies that are sort of in the post-angel, pre-venture rounds, which is the way we defined it back then was these are the companies that may have outstripped the funding capabilities of their early investors, but not quite ready for traditional venture funding just yet. So we wanted to fund that traction gap, so to speak.
You're like A and seed round, basically?
No, it was actually more like a post-seed, pre-A round.
Okay,
right.
got it. And what was like an average investment into one of those 43 businesses?
Across the board, we averaged about 250 to 300 across 42 names at the end of that fund. So the hedge fund business, the hedge fund involvement happened after that.
After all of those 43 companies?
No, during that.
Got it.
After I started the first fund. A good friend of mine back then, unfortunately he's no longer with us, died prematurely, was starting a hedge fund, and he was a good friend, and we talked about it, and he asked if I wanted to join, and I said I always thought that if I can somehow keep some presence in the public equity markets and dabble in small cap, that it will help me as a private investor. Whether that's true or not, who knows, but that's what we ended up doing. So he had a $34 million hedge fund, and he allocated a very little bit of capital for me to be able to dabble in small cap tech companies. And that's how sort of I tried to, bootstrap the learning, so to speak, between public and private. Because there were some publicly traded companies in the small cap range, sub $500 million market cap type companies, that I thought offered tremendous value, because this was post bubble.
And are you still in LA?
I'm still in LA. Yeah.
And so where are most of these investments? Where are the companies based?
They're all over the place. A couple of them were in Asia, but the vast majority were in the U.S. Probably half of them, but a third of them were in Southern California area, and then the rest were California and other states.
And so, what year was the hedge fund formed, or?
I was with the hedge fund from about 2004 to about late 2005. So my friend ended up selling the hedge fund to First Republic's alternative asset division. So after that sale, he stuck around, and that's when I left and basically just cashed out a little bit what I had, and then concentrated full-time in venture investing.
Got it. And so at the time, it was still Frontera, correct?
That's correct. Yeah.
Okay. And so when you say the 43 investments, that was over the life cycle of how long?
That was from 2003 to about 2009.
Okay. So 6 years, which is more time than you spend in any one company.
Yep.
Did you get bored at all?
No, it's actually quite intellectually stimulating, because you get the diversity of different businesses and different entrepreneurs you meet. So it's very different from an operating role where you're constantly tackling the same issues, the same problems, dealing with the same human resource issues. So it was a completely different issue. I enjoyed it quite a bit. I for the first 3 to 5 years, I would say that I was getting the entrepreneurial itch on the operational side, but because I've convinced myself that this was my third startup, then sort of that whole thing disappeared, and kids were getting older, and I thought that was getting older to do another startup anyway. So I enjoyed sort of the ability of allocating assets along different entrepreneurs.
And how do you think you improved over that first 6 years or so in regards to picking your investments? Did the criteria change? Was there a new list of boxes that needed to be checked? How did you decide?
Boy, I don't know. I thought I improved. I guess just, again, meeting different entrepreneurs and learning about the diversity of the businesses they were building, and me having the opportunity to see them, really has that natural effect of learning. You become a generalist. I mean, you don't become a specialist in anything. You become a jack of all trades. But at the end of the day, I went back to my original philosophy of regardless how exciting the opportunity is, regardless how big the potential is, you have to be able to understand the fundamental business underneath all that noise. So I got lucky. I mean, there were really game-changing companies that we ended up touching there. We were the very first, one of the very first few investors in MindBody, which is publicly traded now at about an $800-900 million market cap. We were there at seed. We got involved in Viagogo very early, and it's become essentially the StubHub outside of the U.S. We had a chance to invest in Digital Globe, which is also publicly traded now. A third of them became donuts or zeros. But the few of them that really became meaningful companies really performed very well. So that fund really, back to your question, how I improved, I guess I improved more as I got punched in the gut more, meaning that the only way to learn the VC game is really losing money. And I think you start really getting better when your 250 to 500 becomes a zero.
So when you are a founder and you're a VC, how do those roles compare in regards to network building and building your the community of people around you that you can go to if you have a tough question or if you have a business and an industry that you might want to get different insight in. How valuable has that been?
Well, I guess the nice thing about being an investor or being a VC is people are drawn to you because you're allocating capital. Whether you know what you're doing or not, people assume that you somehow know what you're doing. So the network building aspect of it was relatively easy because you didn't have to proactively search for people that you want to meet. You get to meet a lot of entrepreneurs because a lot of the entrepreneurs that we ended up meeting were pitching for money and for capital. So you build your network that way. You certainly build deeper relationships with companies that you end up investing in and founders you end up investing in. And then, of course, sort of just to have that full effect, you have to start learning. I guess the only part that you're proactive about is getting to know your other investors in the ecosystem, both nearby and elsewhere.
So after Frontera, there eventually was a merger between Wavemaker and Frontera. Is that correct?
That's correct. That's correct. When we were fully invested, so again, I never really thought of myself as a VC, even when I was doing Frontera. I've always thought of it as a more organized way of angel investing among 7 people. So something happened in between when my son was transitioning out of 6th grade, there was an itch that I wanted to scratch, which was going back to the Philippines and actually trying it out there as a working stick or as a professional. So I lobbied my wife if she wanted to go back, and I failed miserably. She did not want to go back. And so when she did not want to go back, I wasn't going to go back by myself, certainly. And that's when I decided, okay, I'm enjoying what I'm doing, so I might as well try to really professionalize what I was doing. And that's when I met the current team I'm with now, David Siemer and Paul Santos.
And so what were they doing at the time?
David was investing out of his own balance sheet. He had a company called Siemer Ventures back then. And Paul was an entrepreneur. So our third partner, Paul Santos, who's actually based in Singapore, is really a prolific entrepreneur. He's built 6 companies, 3 of them are still running and cash flowing. This was about late 2010, early 2011. So David and I sat down in a bar nearby. I've always believed great ideas come out of alcohol, and we were just, sort of kicking the tires. He had started Siemer and Associates, which is the space upstairs that I'm subleasing from. But he's always wanted to invest, and I wanted to spread my wings and be able to build a bigger fund when I decided to professionalize what I was doing back then. So it made sense for us to join forces. So we decided to join forces early 2011 and effectively build what we're calling Fund 2, just to reflect the record of Fund 1, but it's really our first fund together as a team.
And so did in what you were investing in, the investment criteria, did that change when it went from Frontera to becoming Wavemaker, or did it stay?
No. The fundamental premise of our strategy is because we're investing in early stage companies, and at the end of the day, and I don't know if most VCs would admit this, you have nothing but imagination at that point. You have nothing but potential and your ability to imagine how big the businesses are. You have no metrics, you have no validation whatsoever. So I've never really believed in the concept of going big in something that early without metrics or data. So I've always thought that the way to beat this is to really have a broad and diverse portfolio. So nothing has changed. It was a portfolio building approach. We wanted to have a very broad and diverse portfolio. We kind of look at our initial bite size as sort of an entry point, so to speak, buying a front row seat to the future of the entrepreneur. And once we have data and once we have validation and proof of concept, that's when we'll pile on and top up and double, triple, and quadruple down.
So how early are we talking with these investments?
Same, post-angel, pre-venture, we're typically not the first check. There's been some investment, either other funds or or angels, but it's early enough where it's not enough to get what you would traditionally call a venture financing.
So is there usually a product live, traction, revenue, or is it even earlier than that?
So we would invest in pre-product. So we don't market it, but I guess I'm effectively telling you guys we effectively would, but it's a very high bar for us. We typically like to invest in companies with a product. It doesn't have to have launched yet, but it has to be in a position to launch. And we'd like to see our dollars, along with the other syndicate members, that those dollars, that capital will be used for market launch and not for further product development. There has to be a functioning product out there. Doesn't have to have revenues, but we have to be able to at least imagine that there's a quick path to revenue once it launches.
So, segueing into my next question, how does someone get a meeting with you or with Wavemaker? And on the other side of the table, what's the best way to actually raise a round from a venture capitalist?
Well, the best way to get to us would be getting through referrals. We have, the last 13 years I've been doing this, we have invested in over 225 companies. About half of them, or 2/3 of them, are in Los Angeles or Southern California. So the best way to do that would be to be referred by somebody we already know. As you can imagine, we get inundated with a lot of inbound stuff. And we do respond to inbound when it's really interesting. So we read every inbound that comes in. Unfortunately, and I have to apologize publicly for this, unfortunately, most of the time we don't respond to the inbound unless it's something that's within our interest level, so to speak. So we have invested in inbound stuff, and we have responded, but the vast majority don't get a response because of the vast majority of it. So if you are referred by one of our founders or one of the friends of the firm, so to speak, that will count for quite a bit. Because that just gets moved up quite a bit in the queue.
A lot of people who start a company for the first time, even a second time maybe, think that they should go raise a VC round. What makes a company a potentially venture-backed business? What metrics are you looking for? And how can an entrepreneur say, maybe I don't need to raise a VC round?
The best way is not to raise any money at all if you have the ability to do that. But the criteria is all the same for the VCs, especially seed guys. I mean, we look at 4 different buckets. The 4 different buckets are market, product, team, and capital requirements. On the market side, it has to be solving a real problem. It can't be a product in search of a problem. That would be a big issue, and you're going to get turned down right away. If you can prove that there's a real problem out there, you have to be able to defend the size of the market, sort of just product sizing. You know, the bigger the market, the better, obviously. And if it's a big market, there's going to be competitors. So the competitive landscape is a pretty interesting stuff for us to look at early on. Having many competitors is not a negative for us. All that means is there's really a big market out there. Because if there's no competitors, I doubt there's a real market out there. Because I don't care how brilliant the idea is, you're not going to be the first one who's thought of that. Somebody's already thought of that. On the product side of things, you just have to figure out how do you get the product market fit. And so basically what that is have you designed or built the product to really solve the specific problem that you set out to solve? And then of course you try to imagine what the competitive edge of the product is, and ultimately what the revenue model will be. On the team side, it's a little bit more touchy-feely on the team side because this is where we're sort of playing psychologist. It's intellectually stimulating, as I mentioned earlier, but it's tough to pick the right team, and this is where most of the mistakes happen because you do tend to get excited with some concepts. So on the team side, the touchy-feely aspect of it is you try to figure out what the relevant domain expertise of the founding team is, what the relevant domain experience is, and especially for founders that have had some success in the past, why are they still doing it? Sort of the whole cliche, missionary, mercenary thing. I mean, it is something that we look at. And then on the capital requirement side, because we're early stage, the main focus that we look at is how do we help this company get from 0 to 1, so from point 0 to point 1, and we don't really, we'll never know the right answer for it, so we don't really care trying to quantify it, but we try to quantify how much capital a startup needs from the stage they're in to the next stage that they need to be able to create enough metrics that they'll be able to get downstream financing, so follow-on financing. We have to be able to get follow-on financing, otherwise it's game over. We're very upfront with the entrepreneurs. We're not the kind of shop that could take you from start to finish. We just don't have a deep enough balance sheet to do that. So we do care about the capital requirements from point 0 to point 1. It has to be, because we're early stage, it has to be the right deal terms. It has to be valuation conversation is a pretty major thing.
Is there a specific range, or is it case by case?
Most of the stuff we end up doing are sub $15 million in terms of implied pre-money. Reason I say implied pre-money because half the stuff we do are notes. So there's not a real valuation, but you know your pro forma valuation. So it's
Half are convertible notes?
It's easier, it's more convenient, it's cheaper, that kind of stuff. So we don't mind. Some VCs have religion about we only do price rounds. I mean, we don't have any preference. Because at the end of the day, it's fairly binary at the stage we're in anyway. You either have a winner or you're a loser. So I'm not going to spend too much time negotiating something that's not going to matter. And at the end of the day, the very last item we look at in terms of the capital efficiency side is, you have to figure out who's going to want this business. If you achieve all the metrics you achieve, who's going to want to buy you? Or is this is a potential company that goes public? So when I looked at MindBody early on, I just assumed that it was going to be bought the minute it reached a certain scale. I had no clue that Rick Stolmeyer had the ability to really run it all the way. And so he's taking it public, and that was his goal from day one. So once in a while, you get lucky that way.
So I have a few more questions, and we'll open it up to the audience. So talk to us about what's happened in LA over the course of the last few years, and where you see LA going in regards to a startup hub and a place to build new businesses.
So I think it's become a startup hub. This is my proof that it's become a startup hub. There's enough activity. I guess we have to thank the media for that, for romanticizing the entrepreneurial route. More people are, I guess the millennials are becoming a little bit more bold in terms of starting the road instead of going the corporate route. So LA has changed quite a bit from the first time we invested here. Lots of activity. Of course, it always helps that it was a very diversified economy to begin with. I think, if I'm not mistaken, Southern California, the basin itself, is the 13th largest economy in the world, California being the 6th. So there's plenty of problems to solve here. There's plenty of talent here. The local universities graduate quite a bit of engineering talent, which is obviously something, the critical ingredient for a lot of these tech startups. So I think there's no question that LA has become a hub. I realize LA and New York sort of go back and forth between number 2 and number 3 in terms of volume of funding. But I think LA is. We've invested in some companies in New York, but I think LA is a lot more vibrant than that. LA has a lot of strong points. Culturally, entrepreneurs here we found are a little bit more concerned about getting to revenue phase quicker than companies up north. It's maybe primarily because of the need. There's less capital here there's enough capital, but there's nowhere close to the capital that the Valley has in terms of giving you the ability to keep experimenting without creating that business model. So LA has changed quite a bit, and content will always be a pretty big differentiator for LA, and I think content will always be in LA. AR, VR is a space that's really heating up quite a bit. It's not a space that we're touching. We don't feel that we have the core competency to figure out the differentiation yet, but I think the marriage of hardware and content will ultimately decide that space. I don't think the hardware space is as capital efficient, which is why we're not touching it. And the content is going to be expensive, which is why we're also not touching it. But as a consumer, I'm looking forward to it, and I think LA will be the base for that.
As far as Wavemaker goes, and yourself personally, what, if any, do you have goals for the future? Are we Is there a benchmark you're looking for? Are you maybe going to start something else? What do you think?
No, I'm too old. I'm 48 years old. I'm too old for a startup. So I will stick with my day job now. And the goal is to just keep on doing it. We're investing out of Fund 3 now. There's going to be, we're going to raise the next fund next summer. So we'll just keep on going. And I mean, I'm a very lucky guy. I mean, there's the reasons I enjoy. There's 5 reasons that I tell everybody why I enjoy it. Is every time I'm asked. I think I've mentioned the first one, which is really it's intellectually stimulating because fundamentally entrepreneurship is about solving problems, and so it's not a surprise that it's very intellectually stimulating. As I also mentioned earlier, I really enjoy the diversity of the business that I learn about and the entrepreneurs that I meet. The third reason is I really get us a boatload of psychic income seeing something being created out of nothing. It sounds ridiculous, but I think that's, to me, having been around the block a couple of times now, it's a lot more satisfying sometimes than the actual financial returns. The fourth reason is a little corny, but it's true, I believe, that there is a social utility to early stage. It leads to a lot of good things that improves society in general. And last but not the least, the fifth reason is if you really have the right investment horizon, and I'm talking about 10 to 20 years, and have the right stomach for it, it will outperform any and all asset classes out there. But you just have to have that 20-year horizon, which is most people can't imagine 20 years. In our case, we have no choice because the fund life is 10 years. So those are the reasons why I enjoy it. And in terms of Wavemaker, we hope to cross the 200 million AUM assets under management by end of next year. And a third of our investments are still being done in Southeast Asia. We have a fair amount of cross-border practice. We have a team of 7 people in Singapore. In fact, it's a bigger team in Singapore because they do lead a lot of investments. Ours in the U.S. are mostly co-investments. So we hope to keep doing this for as long as our LPs remain supportive.